artificial intelligence has become the defining obsession of the global economy. From Silicon Valley to Wall Street, every conversation, every investment, and every headline seems to circle back to AI. Companies are rebranding around it, investors are pouring billions into it, and governments are racing to dominate it. It's being called the most transformative technology since electricity, a force that will reshape industries, economies, and even civilization itself. But beneath that excitement, something else is forming, a familiar pattern we've seen before: rapid valuations, speculative funding, and sky-high promises of limitless growth. Some economists now warn that we may be entering the early stages of an AI bubble, one that could deflate just as dramatically as it inflated. So, what's really happening in this AI arms race? And how risky has it become? Let's start with the scale of the boom. In just 2 years, tech giants have invested hundreds of billions of dollars in AI infrastructure, data centers, chips, and cloud platforms. Microsoft, Google, Amazon, and Meta are spending at record levels. NVIDIA, the chipmaker powering much of the world's AI revolution, briefly hit a $3 trillion valuation, becoming one of the most valuable companies in history. Startups are chasing the same wave. OpenAI, Anthropic, and Mistral have raised billions, with valuations soaring beyond $10 billion. Venture capital is flowing again, and nearly every pitch deck now includes 2 letters, A and I. On the surface, it looks unstoppable, but beneath that, there's a growing gap between expectation and reality. Most companies in the AI boom aren't making significant profits. Training large AI models costs hundreds of millions of dollars, and maintaining them costs tens of millions more. Many of these firms are operating at massive losses, betting that profits will eventually catch up. The same logic that fueled the dot-com bubble in the late 1990s. Even big tech is feeling the pressure. Microsoft's annual capital spending has crossed $50 billion, largely on AI infrastructure. Google and Amazon are spending at similar levels. It's no longer just innovation, it's an arms race, driven by fear of missing out rather than grounded profitability. That's one of the first warning signs of a bubble, when money flows faster than measurable returns. The second warning sign is valuation fever. AI-related stocks have surged at unsustainable rates. NVIDIA's value tripled in under a year. Smaller AI startups with little revenue are getting billion-dollar valuations. Investors aren't pricing based on performance, they're betting on potential. That's classic speculative behavior. We saw it during the crypto mania of 2021 and the metaverse craze of 2022. Each time, the narrative sounded rational, until it wasn't. Now, to be clear, AI isn't a scam. The technology is real, powerful, and transformative. But that doesn't mean the market around it can't overheat. History shows that most revolutions, railroads, electricity, the internet, start with a bubble. The speculation accelerates progress, but it also sets up a correction when the hype runs too far ahead of the results. The real question is whether AI's economic payoff can match the expectations. Right now, most companies using AI are still experimenting, improving productivity, automating tasks, or enhancing customer service. But the big profits haven't arrived yet. Generative AI tools like ChatGPT and Gemini are impressive, but they're expensive to run and hard to monetize. Even OpenAI, a global leader, is still figuring out how to make its business truly profitable. For large enterprises, AI integration is also complex and costly. It requires data infrastructure, retraining employees, and navigating compliance. Many are realizing that adopting AI isn't a quick win. It's a long-term investment with uncertain returns. That gap between massive spending and slow results is exactly how bubbles form. Everyone bets on a future that isn't quite here yet. Then comes the infrastructure problem. AI runs on staggering amounts of computing power and electricity. Data centers are consuming record levels of energy, and GPU shortages remain an issue. Companies are spending billions to build capacity they might not fully use for years. If demand slows, those investments could turn into expensive mistakes. But the race continues, because no one wants to be the one to stop investing first. That's the paradox of this AI era. It's too costly to win, but too risky to quit. So, what happens if we are in a bubble? History offers a clear pattern. First comes excitement and growth. Then expectations rise faster than profits. Eventually, reality catches up. Growth slows, investors retreat, weaker players collapse, and stronger ones consolidate. That's what happened with the dot-com crash. The internet didn't disappear. It matured. Companies like Amazon and Google survived because they built real businesses around real value. The same will happen with AI. The technology won't die, but the hype will. And maybe that's necessary, because bubbles, in their own way, fuel progress. They attract talent, speed up innovation, and build infrastructure that outlasts the speculation. The trick is surviving the crash when it comes. So how can businesses and investors protect themselves? First, focus on real value, not buzzwords. The winners will be those building tools that solve problems and generate measurable returns. Second, manage cost and scale wisely. AI development is expensive, and even big companies can overextend themselves. And third, remember history. Every major innovation, from the dot-com era to crypto, has gone through a cycle of hype, correction, and consolidation. AI is real. It's transformative. But not every company riding this wave will survive. The hidden risk in this arms race isn't the technology itself. It's the illusion that it can only go up. Because if there's one thing markets always prove, it's that when everyone believes something is unstoppable, that's exactly when it's most vulnerable.